Hi, everyone. Jim Curzan here with Kaydan Wealth Management, and welcome to another capital market review. This one covering all the activity for the first quarter of 2021. And as always, before we get into this, just remember that all the opinions, comments are those of myself, Jim Curzan, as well as our firm, Kaydan Wealth Management, and do not reflect opinion of Raymond James or any one of our custodians. As we do every quarter, we come up with a theme that better reflects kind of where we are or what concerns we're dealing with as of this moment. And right now, the theme is light at the end of the tunnel. The economy matters. And one of the reasons that we put these presentations on is we think it's important to get a better understanding of where we see ourselves in terms of the economy. So in this presentation, we're going to dissect a number of major economic components. We'll talk about growth, we'll talk about jobs, corporate profits, inflation, as well as interest rates. Because when we have a better understanding of the economy, we have a better understanding of our opportunity sets. And in this presentation, we're going to try to attempt to answer both where we are in terms of the economy, but most importantly, where we're heading. To get the investment side of this right, we need to know two things. One, where we are in terms of the economic cycle, and also where the Fed is. Right now, we would have to say that we're exiting a recession. You'll see that we're not fully recovered, and we're entering an economic recovery stage. A year ago, a little over a year ago, before COVID, we were clearly in a very mature market, entering a much more aging market. And the opportunity sets are quite a bit different. With the Fed, we would have to say that at this point, they're very much on board with loosening and accommodation, both in terms of interest rates, but also a number of other credit facilities. As we find ourselves today, entering the second quarter, we also find ourselves dealing with two large surges, one fiscal and one a result of vaccination. To date, the government has just recently put together a $1.9 trillion package, the American Rescue Plan, and that will provide about $1.2 trillion directly into the economy in terms of cash spend the next 6 months. And the hope is that a lot of that will go to low and middle income households who have a propensity to spend as opposed to save, which will help stimulate the economy even further. On the vaccination front, we are now at a point, Johnson & Johnson aside, now at a point of almost 2.5 million injections a day. And the thought is we should see herd immunization shortly, certainly this year, maybe as soon as May, certainly by summer. And that becomes a huge game changer. So today, as far as our agenda is concerned, we're going to touch on 4 issues. We want to talk a little bit about where we are with respect to the pandemic, what the course of the pandemic looks like. We will talk about the pace of our economic recovery. We'll show some slides indicating that we're not kind of back to where we were before all of this hit the fan. We will also talk about fiscal and monetary policy and how that affects interest rates and the bond market. And we will also talk about equities and the need for diversity. And we would be remiss if we didn't talk about equities and diversity without talking about risks as well as opportunities. So let's jump right in and talk a little bit about this pandemic. You know, it would be a huge mistake to talk about where we are right now in terms of the pandemic without first focusing on the huge amount of loss that we've seen. To date, in our country, we've had 32 million cases of COVID. And sadly, 578,000 souls have passed as a result of COVID. But we're beginning to see some opportunity. And we're beginning to see that slowing down a bit. The chart to the right talks about herd immunization and kind of where we are, and more importantly, where we expect to be in the next couple of months. And we're very close. Herd immunization is somewhere between 60 and 80% of the population immunized. Call that 70% is kind of the midpoint. And you can see that we're probably at 52% right now when you combine folks that have been vaccinated, folks that have recovered from COVID, and also folks that have recovered from COVID and have also been vaccinated. So we're getting somewhat close to that point. That's why a target of May, late May or July certainly is within reason. The chart to the left talks about a 7-day moving average. Light blue is confirmed cases. Dark brown or black gray, I guess, is fatalities. And you'll see the number of fatalities have fallen off a cliff. Thankfully, part of that is because of the vaccinations and the fact that the elderly are somewhat less vulnerable. But as far as confirmed cases, we're seeing a little bit of an uptick, which has gotten certain communities a little concerned. Certainly the state of Michigan is one of those states that's leading the nation in confirmed cases. But if we kind of look at that a bit closer, we'll see that a lot of those cases are actually in the age 0 to 10 and 10 to 19 range. Some of that might be because of reopening of school, sports, might be also the fact that this group is more than likely yet to be vaccinated. And we also have a few more aggressive strains that we're dealing with as well. But it certainly looks like there is light at the end of the tunnel as we look at how close we are to herd immunization. Let's now switch gears and look a little bit at the economy and the recovery itself. When we look at this chart, which is payroll employment, you'll see that we're not quite where we need to be. The chart on the left talks about employment. And what's really interesting about this is if we look at the prior 10-year period before COVID, February of 2010 through February of 2020, we gained 22 million jobs over that 10-year period. Fairly robust growth when it came to new job creation. We lost almost all of it in about a 2-month period because of COVID. And at present, we've regained about 13 million of those jobs, about 58% of the jobs lost. Not quite where we need to be, a lot more to go. On the right, we talk about where the jobs have been regained and in what industries. Construction has regained more, let's say, than leisure. And there's still quite a bit to go. Now, the problem with this is a lot of the skill jobs have been readily filled. And a lot of the jobs that still remain, unfortunately, happen to be in the leisure and hospitality space. And we won't see huge improvement there until we're fully engaged, fully open, and everybody is less concerned. And that may take a while, especially with this somewhat of an upswing in COVID cases. Just as we saw payroll and new job creation still has a ways to go, the same is true with economic growth. We will see that the long-term trend in terms of GDP growth in our country is about 2.5%. That's represented as that dotted blue line. The dark gray line, you'll see the huge drop off of that, about an 8% drop in GDP activity. To put that in perspective, during the financial crisis, as bad as it was, and by the way, the S&P dropped nearly 60% from peak to trough over about an 18-month period. But when we had the financial crisis, our GDP dropped by about 4%, which was huge at the time. Noting that period as the Great Recession, only second to the Great Depression. And here, in the matter of 2 months, we lost twice that in terms of GDP activity. we still have quite a ways to go. And it may take a while to get back to full GDP activity. We're expecting sizable growth this year, and that'll go a long way toward improving that. So we could see as much as maybe 6% GDP growth this year. That would really help quite a bit. Again, looking at unemployment, but this time through a wage lens. And you'll see the gray line representing the unemployment rate. You'll see it spiked. We went from literally 3+% unemployment to 14.8% unemployment in a matter of 2 months. And at 14.8, it is significantly larger than what the unemployment rate was even during the Great Recession. Today, we're at about 6.2% unemployment. We have a ways to go to not only get back to where we were, but to get back to just simply full employment, which is approximately 4% unemployment. Now, what's happening though is as jobs are coming back, and a lot of those jobs are not in leisure and entertainment, they carry with them somewhat of a more sizable wage package. So we're actually beginning to see some wage growth as well as folks are coming back into the workplace. And the wage growth is tracking at about 4%. And you can see from the blue line, that's kind of above trend, certainly above the trend that we've seen the last several decades. So we'll have to see whether that may in fact be somewhat inflationary at some point down the road. The recession was horrible. And as a result, it certainly hurt corporate earnings. In a matter of months, corporate earnings went from tracking reasonably well to losing about 22% of profit margin. We saw companies' earnings contract by 20+%. When we look at the stimulus, we look at the amount of vaccinations, we look at the expected growth, we can only hope that that will improve. And expectations this year is S&P 500 earnings will be back on track, tracking kind of where they were prior to all of this, back at effectively all-time highs. That said, we wonder whether an increase in corporate tax rates, an increase in wages, or an increase in interest rates may at some point in time create somewhat of a headwind for corporate earnings. Clearly, all three of those can have a negative impact in terms of margins. So we'll have to watch that closely. One can't have a dialogue regarding the economy without also talking about inflation. This chart represents headline as well as core inflation. The light blue line that you'll see that's a bit more wiggly, bounces all around, is the headline CPI or consumer price index. And then the dark gray represents core CPI. The difference is core CPI excludes food and energy. And because of that, you'll see that the rate has been really quite low, about 1.4% or so, as is referenced here by the chart. That would be certainly well beneath the 2% target by the Federal Reserve. And a lot of that reason is cheaper energy prices, as we've seen. You'll see January of this year, energy dropped by about 3.8%, has a huge impact. But we're beginning to see food starting to increase. We're also seeing some concerns about some dislocation in energy because certain wells have been taken offline, et cetera. And we'll see how that impacts. Also, wages, which are built into core, are beginning to rise a bit. So there are a lot of folk out there that believe that we will see a higher degree of inflation. Additionally, the government is making some adjustments to their view on inflation. And we will talk a little bit about that as we look at Fed funds and interest rates. And I think this is a great time to do that. This chart represents prevailing interest rates, or the Fed funds rate. In fact, that's the only rate that the federal government really controls and moves. And you'll see that generally it's been stair-step down over the last 20 plus years. If you look at where we were last year, we had a huge drop in the Fed funds rate, taking it down nearly to zero to 0.25%, which is where it is today. A lot has happened over this last year. Interest rates are still remaining low. The Federal Reserve plans on keeping them low, at least for a while. The expectation is no real big move in Fed policy, either interest rates or quantitative easing for the next, let's say, year. However, we're beginning to see some dialogue to the contrary. Chairman Bullard of the Kansas City Fed mentioned that they might reconsider this should we hit 75% herd immunization. The other discussion was doing nothing until full employment. At 6.2% unemployment, does that mean 4% unemployment? And how close and how soon will we see that? So at the very end, you'll see the plot charts, the dot charts as they're called, market expectation, as well as the FOMC's expectation as well, and all reasonably benign, not expecting a whole lot of movement in the interest rates. But there's been a lot that's happened here in this last year. For one thing, the Federal Reserve last August adopted what's called the average inflation targeting method. So now they're not necessarily looking at 2% inflation as a warning sign. They're now saying, look, we've missed our target. In the last many years, we've underperformed 2%, meaning inflation's been a lot less. So now we're using a rolling average so that we can make up for some of those years where inflation was less than 2. So the expectation is, should we see inflation of something greater than 2, it will not sound alarm bells with the government, at least at this point in time. So we might have greater sustainable inflation. And then just recently, last month, the Federal Reserve changed or updated their target for GDP this year to 6.5%. That was up from 4.2, which is fairly dramatic. And they also increased their target for inflation. Remember, last slide showed inflation to be about 1.4. Now they're looking at about 2.2. Again, in part because of the stimulus as well as wage growth rates. Let's talk about interest rates and inflation. And this is the 10-year Treasury. Again, the government doesn't control this, but auctioneers do. Buyers and sellers of bonds meet every time the government is borrowing money, and they set the price. And lately, they've been demanding a higher yield, meaning a lower price for the bonds, to hedge or protect themselves against the possibility that over the 10 years remaining on this new bond they bought, interest rates may be a whole lot higher. So they want to bake in a higher cost to avoid the opportunity cost of being way underneath the market. So interest rates have gone from about 0.7% for a 10-year bond just months ago to 1.77 recently. And today it's 1.6 something and some change. So what we're looking at are two lines. The blue line represents the nominal yield. That's the actual yield that we see in the marketplace. And you'll see how that is moving up and is moving up fairly quickly. And then we have the dark line, which is real interest rates, which takes into consideration or subtracts out inflation. So up until just recently, real rates after inflation, but before taxes, was actually a negative number. Put money in a 10-year bond, there's a very good chance you're not keeping up with the price of goods and services around you. And that's before we even discuss taxes. Today, it's a bit better than break even, and that's because of this huge increase in interest rates. This is also impacting the US dollar, as now our 10-year bond at 1.7, let's say, is much higher than other 10-year government bonds elsewhere. So money's flocking into the US, driving the US dollar higher, and it makes international investing a little bit more difficult in the short term. Let's talk about equities and diversification. Before I do that, let me take a step back and say, hey, this thing about interest rates, making bond investments very, very difficult. Remember, when interest rates go down, bonds go up. And when interest rates go up, bonds go down. So it's not a surprise to see the move upward in 10-year yields reflect on bond prices this year. As of this recording, the Barclays Aggregate Bond Index, which is kind of the bellwether index to get an idea what's happening in bond land, is actually negative on the year, about 3.5%. So the expectation is, look, if interest rates continue to go up, we're going to see somewhat rough sledding, some headwinds on bonds. Remember that. I'll try to bring that into this discussion on equities in a moment. This chart shows the S&P 500, which is a fairly strong bellwether index for the U.S. stock market. And we see that the PE ratios, the price earnings ratios, or the benchmark that is used to determine whether the market is somewhat expensive or less expensive, the higher the PE, the more you pay for every dollar of earnings. And right now, the PE as of March is almost 22 times earnings, and that's significantly higher than the 25-year average of 16.6. So by looking at this, we would certainly say, hey, the market is expensive. And if you look at PE or the cyclically adjusted PE, this is in the box, the CAPE index, or you look at dividend yield or price to book or price to cash flow, all of those metrics are quite a bit more expensive than the 25-year average. The only one that is still somewhat favorable is the earnings yield, which is kind of the upside down PE as it compares to the bond index. That used to be Alan Greenspan's favorite metric. It's still used today, but it's the only one that somebody can grasp and say, aha, see, things are still cheap. So the conclusion is PEs are high. One might say that they can be high because of the super low interest rate environment. The way I look at this, I would say the current PEs somewhat reflect the big drop in earnings that we saw last year as a result of COVID. And as the economy recovers, as profits re-engage, which are expected to do, the earnings increases, so a bigger denominator, a lower the multiple will be, and that will somewhat help. But we are looking at an environment where things certainly are expensive, and it's hard to play these indices. It's better to look at targeted investments and identify certain sectors or subsets of the market as opposed to the broad market because it is so expensive. This chart brings both of those together, stocks and bonds, in a 60-40 portfolio. What if 60% of the portfolio is the S&P, and what if 40% of the portfolio was bonds? And what this is looking at is the inverse of the PE, which is the earnings yield, as it compares to the Barclays bond yield. And when you're looking at simply a 60-40 portfolio, that all you're doing is buying the S&P and the Barclays Ag, and there are a lot of funds out there that do just that. We're sort of looking at earnings potential of about 3.2%, pretty low. So if there's something to learn from this chart, it's broad-based indexing is going to be rough sledding. It's better to dissect those indices and identify sectors. For example, small cap versus large, maybe some international versus US, maybe those industries that are more geared toward reopening and less to do with technology or some of those spaces that would have performed so well last year. Doesn't mean that portfolios will only earn 3, but it does conclude that active management might be a better way to go than passive. In years gone by, passive worked just fine. We're coming off of a long period of time, probably 10 years, where passive has totally outperformed active, and now we're beginning to see a huge outperformance with active management. We've seen it with our own client portfolios. Growth versus value. This chart indicates relative value. When you're above the horizon, growth is cheap and value is expensive. And when you're below the horizon, value is cheap and growth is expensive. And you can see for quite some time, growth was cheap and made good sense. That has changed. The advantage now goes to value, and we think the advantage can go to value for quite some time. It may be the next couple of years, potentially, that value can certainly outperform. And we think that there will be opportunities in things like industrials and financials and energy, materials, real estate, utilities, whereas technology, consumer services, et cetera, may have already had their best days behind them. International securities, as I said before, in the very near term, somewhat rough sledding because of the US dollar. When the dollar goes up, it makes it more difficult to convert our profits overseas back to the US because we lose on the currency. When the dollar weakens, there's huge improvement. And we expect the dollar as a trend to somewhat weaken at some point. Our debt service, the total amount of our national debt to GDP, does create some headwind and should cause for some weakness in the US dollar. And that may be a longer term trend, which puts the advantage back to international. But regardless of that point itself, international generally is very inexpensive. When you look at earnings growth potential, it is very, very strong. When you look at current valuations as they compare to 25-year historic, they're very cheap. So when you start looking longer term, it's not a huge surprise that just about every econometric shop that gets paid to opine on this particular subject is certainly suggesting having more international exposure. Right now, with a lot of our accounts, our international exposure is light. It's 3 to 5%. Really clearly an understatement. And to date, that's been the right move. International has underperformed because of the dollar strength. We think that may change, though, in months and years to come. One last point regarding the market. We should see greater volatility. This chart shows the S&P 500 value, the midpoint, the median, which is a green color. And then the grayed area is the dispersion of valuations, PE values bouncing all over the place. And you'll see that this dispersion is increasing. It's widening out as we move left to right over the last decade or so. As you get greater dispersion, the advantage essentially goes to active investment. When it's tight dispersion, then buying the index just simply makes a whole lot of sense. And that was true coming out of the Great Recession for 5 or 6 years. Passive certainly outperformed active. But now we're certainly beginning to see where active has a major place in most portfolios. One more point I'd like to make before I conclude, and I appreciate the time you've all spent with me today. Getting back to that slide about getting it right and the two things we need, where we are in terms of the cycle and what the Fed is apt to do. You know, when you look at the stock market and you look at how well it's doing, and more importantly, how well it shakes off bad information or information that might be deemed to be more negative than positive, one would conclude that the market is somewhat priced to perfection, and it is assuming a real positive outcome for a number of different attributes. And I'd like to just spend a moment going through, as I see it, the 5 key elements that have an impact on this market and can certainly have an impact on expectation and consumer confidence, and can take what is now kind of this perfect utopia and cause some degree of question and more than likely some degree of volatility as well. So they are, in no particular order, COVID and the vaccine. The market right now is assuming, hey, we're going to come out of this thing very, very, very quickly. In the last couple of weeks, you've seen this fight occurring between the stay-at-home community, that is those securities that do well in that space, versus the let's see the economy reopen. Clearly different companies. And for several months now, it's been the recovery stocks that have been really outperforming the stay-at-home crowd, the technology companies that allow us to stay at home and live a somewhat normal life. The last couple of weeks, as a result of COVID case counts rising, certain concerns about certain injectables, we've begun to see the advantage going back a bit to some of these same big tech companies, those that did so well last year. And as a result, it creates a little bit of consternation. We feel the recovery is at hand, and we think ultimately it's those stocks that will do well. But if for some reason we have bad information about the vaccines, we have a slowdown in terms of economic recovery, that could have a big issue. And a lot of that is driven by COVID. The market today is priced to perfection as it relates to economic recovery. We're expecting a huge recovery in the economy and in terms of corporate profits. That doesn't necessarily mean that we're going to get the same recovery in the stock market. How many times have you seen before a company report terrific earnings and the stock goes down? Why? Because what they reported was less than what was expected. Or better yet, a company that reported a huge loss and the stock goes up. And it goes up because the loss, while it was large, was less than anticipated. I think a lot of good has been baked into this market. So we're really looking at where can we remain active and participating, and where can we reduce some of our exposure as well, because we're pretty sure that a lot of the good has been baked in and we don't know what other positive surprises we could see. Whereas I can list a lot of things that might fall flat. Stimulus and spending expectations. At this point, the government is full dose of low interest rates, full dose of quantitative easing. But we're beginning to see hints of maybe we'll need to have a discussion. Chairman Bullard, as I said, is thinking 75% immunized. We might want to start taking the punch bowl away. Maybe start with reducing quantitative easing. I remember back in 2013, taper tantrum. The Fed unexpectedly raised interest rates. Market wasn't ready for it, and the market dropped, I think it was 19% or so in a single day. Not expecting the same. We hope that this current administration will telegraph things a bit better, but clearly when the punch bowl is taken away, there's less to support the economic activity. 10-year treasury yields, they moved up and they continue to move in that direction. At some point, yields, maybe over 2, maybe over 2.25, start to become a bit of a headwind with the market. Rising interest rates work in opposite direction with growth stocks. Technology stocks tend to go down when interest rates go up. So we have to watch that as well. And last but not least, and I think I covered this as well with the economy, but the Fed and what their policy is will have a huge impact. I would also say that in addition to Fed, we could also talk about fiscal policy. Taxes may certainly affect the market. Additional spending as it relates to debt could certainly translate into a weaker economy as more and more of our productive capability is being used to cover interest rates, so on and so forth. So just to let you know, these are things that we look at. We have conversation about this weekly, every Wednesday at 1 o'clock. And as there's need to adjust and change, rest assured that we will make those changes with those accounts that we actively manage. That said, I want to thank you for attending. By the way, if you know anybody, friends, family, somebody who you would like to have us have a conversation with, we would love that opportunity. And we'd love to be able to provide them a second opinion, or at least get a sense for what we might be able to do that might be a little bit different. As you know, we have kind of an elegant process. We call it our evolutionary wealth process. It starts with a pretty deep dive, a discovery meeting, and then moves from there through the planning process. And we would love the opportunity to be able to do that with friends or family that you care deeply about. As always, if you have any questions, please call our number listed below, but also just simply go to our website or email us. We'd love to entertain any questions you have on this presentation or anything else. We're here to serve. Hey, we'll do this again next quarter. Talk to you soon. Stay healthy, stay safe. Thank you. Bye.